SmartFination update right here, and I need you to pause everything you're doing immediately. Silver has just reached $125 per ounce on the Shanghai futures market. Let me repeat that clearly, $125. The Shanghai markup above COMEX has surged dramatically to $15, $17 per ounce. The US markets haven't even opened yet. If this material is providing genuine insight and encouraging your own critical thinking, leave investors SmartFination in the comments. It helps me and the crew tremendously. We track it to see who's truly engaged with facts. If it doesn't click for you, that's fine, no resentment. There are endless conventional viewpoints available elsewhere. I'm focusing now on dedicated independent thinkers only. Let's return to the developments. Silver posted an all-time peak around 28,000 yuan on the Shanghai Futures Exchange. This momentum is now pushing COMEX silver prices toward $110. This isn't a mistake. This isn't exaggeration. This is the tangible market loudly warning the futures market that a core issue has emerged. But grasp this key point. This goes beyond a simple upswing. It's a warning sign. A $15, $17 difference between Shanghai and COMEX isn't typical fluctuation. That's a fundamental break in the worldwide valuation system for silver. Allow me to explain the current situation, its importance, and the near-term effects for those owning actual metal or monitoring these markets. First, the basics. With Shanghai quoting $125, COMEX sits roughly at $109 to $110. That $17 difference creates a clear profit chance through arbitrage. Normally, one could purchase on COMEX, transport to Shanghai, sell there, and keep the extra after costs for freight and coverage. Yet that flow isn't occurring rapidly enough, and that's highly revealing. This markup didn't form suddenly. It's grown steadily over months as China has strengthened restrictions on key metals, accumulated vital supplies, and observed Western stockpiles shrink. Examine COMEX registered stockpiles. Each delivery pressure episode removes a few more million ounces from availability. The chart patterns are equally impressive. Silver smashed past barriers at $15 effortlessly. Short-term RSI levels show extreme overbought conditions. The trading volume supporting this advance feels authentic. This isn't a thin market flash that fades quickly. Here's the aspect that should worry anyone still trusting COMEX determines worldwide silver values. If Shanghai maintains a $15, $70 markup, it indicates the real market in the planet's top industrial nation has separated from Western futures-based pricing. That's not brief disruption. That's a lasting change in global silver assessment. China leads in silver usage for manufacturing, solar modules, gadgets, electric vehicles, 5G networks. If buyers there accept $125, they're either urgently short or aware of upcoming shortages unknown in the West. We're amid a worldwide competition to lock in essential resources. Silver functions not only as currency or investment, it's a vital industrial element with few alternatives and key uses. Solar production requires it. Advanced electronics demand it. The shift to clean energy that major nations pursue needs silver volumes exceeding current mining output. The U.S. advances domestic production and supply security. Trade barriers serve as tools. In this setting, a $15, $17 Shanghai markup isn't merely classic economics. It's securing local access in a landscape where international reliability falters. The key mid-segment insight that reframes our entire discussion, this Shanghai markup spike occurs while Western large investors remain mostly sidelined in silver. Funds, retirement plans, state wealth vehicles beyond Asia have stayed light on precious metals for years. We face a worldwide silver revaluation across platforms. Picture it. Asian purchasers pay $125. Western investors buy futures for profit capture or risk protection. COMEX stocks fail to satisfy delivery needs. Backwardation, spot above futures, persists rather than briefly appears. Then futures lose authority as the benchmark, and genuine value emerges from physical reality. I know some will say this might fade. It could be temporary pressure. It might unwind when Asia ends and US begins. So examine the downside possibilities, obstacles, and why this may not endure. First, if it's solely a Shanghai-driven squeeze from major players or a contract glitch on their exchange, the gap could vanish rapidly. We've witnessed brief markups in other goods from isolated issues. Second, future systems have handled huge stresses historically without failing. COMEX holds options, higher requirements, pauses, cash resolutions if delivery proves impossible. Concentrated short holdings shown in commitment reports belong to well-funded, connected entities. Third, rapid gains prompt cashing out and chart-based exits. The urge to secure 20-30% in days is strong. That could halt progress, despite genuine shortages. A sudden dollar rally from Fed tightening or risk aversion could pressure silver with other assets. The macro setup remains delicate. Political surprises, debt issues, funding squeezes. Any could disrupt commodity momentum regardless of basics. If leveraged, margin-based, or using essential funds, don't pursue the surge. Yet the positive outlook strengthens despite those threats. The Shanghai markup stands amid months of buildup. COMEX stocks falling, London exchange levels steady or lower, Shanghai gold markups also high. Factory needs for silver exceed mining by growing amounts yearly. Political divisions make metal transfers uncertain. The $15-17 Shanghai markup visibly shows an underlying supply shortage. China's solar expansion alone demands hundreds of millions of ounces yearly. Electric vehicle growth is just starting. AI facilities require silver for advanced tech. Defense needs are mandatory. These aren't optional. They're essential uses that persist despite higher costs. And the twist: if COMEX attempts price control while Shanghai offers 125, arbitrage will empty COMEX stocks quicker. A $17 valuation split can't last without metal shifting to the pricier zone. Without deliverable supply, the futures framework weakens. We may witness the start of a worldwide silver market transformation. The era when COMEX and LBMA dictate values while Asia and physical demand simply follow could be closing. Shanghai essentially states, we'll pay the necessary amount. If the West insists on futures tactics, okay, but the actual metal heads elsewhere. For physical holders, this confirms your choice. The extra cost you've accepted over spot for coins and bars, $8, $10, $12, weren't overcharges. Now Shanghai validates it at scale. For active traders, the position offers both potential and peril. The drive is clear, but sharp reversals loom. If positioned long, check your exit levels. If considering entry, avoid chasing after a 15% daily jump. Await stabilization or retreat to key support. Patience outperforms impulse always. Availability limits supply, not quoted prices. 2. If the split endures, it undermines Western futures as the universal benchmark for silver. 3. The blend of factory demand, strategic reserves, and shrinking stocks builds a shortage that price rises may not fix soon. The open question: will COMEX and LBMA accept this valuation truth or resist via higher margins, cash closes, or oversight moves? We don't know if Western big money joins or waits, and we don't know if Shanghai's $125 readiness is brief pressure or a lasting adjustment. Monitor COMEX registered stocks this week. Track retail coin and bar markups. Observe if London and New York values approach Shanghai or the divide grows. This isn't a moment for relaxation. Research independently. Confirm facts. Know your risk level. If holding physical, clarify your purpose and any sell thresholds. This is major change happening live. The clash between futures valuation and physical truth hits a turning point. Remain alert, stay updated, and ignore claims this is merely another up move. Approach with reason, not excitement. Smart Fination out.